Good afternoon, everybody. My name is Brian Treese, and I'm honored to serve as the President and CEO of the Findlay-Hancock County Community Foundation. Welcome to the 2021 Investment Briefing. A few housekeeping items. There's a chat box to send messages directly, as well as a Q&A option. We will take questions at the end of the presentation, but please submit them as you think of them throughout. This meeting will be recorded and shared later. Now I'd like to introduce the Foundation's Finance and Investment Committee. This group stewards the Community Foundation's assets by reviewing financial statements and reports, safeguarding the organization's assets, and monitoring investment performance. The members are Chairperson Gary Pfeiffer, Tom Donnell, Beverly Dowling, John Haywood, Ginger Jones, Alec Reinhardt, and Chuck Younger. Myself and our Chief Financial Officer, Richard Brown, are members ex officio. Should you have questions after today's session, Richard and I would be happy to answer and confer with this committee as needed. At this time, I'm pleased to introduce Bill Hummel. Bill is the Foundation's investment consultant and is a managing principal at Fund Evaluation Group. He has 30 years of investment experience and has been with FEG for 25 of those years. The virtual floor is all yours, Bill.
Great, thanks, Brian. Appreciate your time and certainly everyone else's time. So I'll walk through the presentation here and touch on the following subjects here. One, touch on FEG's investment philosophy, as well as cover some of our current market environment topics, and then tie that into some of the key macro developments that are going on right now in the marketplace. And then after that, wrap up with an asset allocation performance review of the foundation. And then Brian had mentioned, turn it over to questions through the chat or Q&A functions that you have available to you. So with regards to investment philosophy here at Fund Evaluation Group, it's really four main principles in place with our firm's investment philosophy that we share with the committee. One, to keep a long-term investment perspective. And what does that mean? Well, obviously the Community Foundation's assets are managed in perpetuity, essentially allowing itself to have real growth of assets that covers both spending and inflation, as well as fees. And essentially that allows the Community Foundation to spend in real dollars after inflation, not only today, but also 50 years from today, 100 years from today. And so we're not likely to make knee-jerk reactions to the marketplace or certainly pivot on a dime. We know that this is money that has to stand the test of time. Step two is valuation consideration should drive investment decisions. This one's a little bit tougher in this market environment. Valuations don't look as cheap as what they were even before the pandemic. They look more expensive right now on the equity front, and fixed income yields are at all-time lows for the most part. So valuation from time to time should drive our investment decisions, and has done it in the past, even more recently as March of last year during the pandemic, when we rebalanced and really bought more into equities during the dips like that. But in this current environment right now, that hasn't presented itself. It's really been sentiment and other fundamentals driving investment decisions. Third category for investment philosophy for our firm is diversification on global risk factors. I'll touch on that a little bit further on the next slide, but really diversify the asset classes, not sure which ones are going to lead or which ones are going to follow, but make sure you have representation in most of the asset classes that are utilized out there in the marketplace. And then lastly, use skillful active management to add value over time. The portfolio for the Community Foundation has 3/4 of its assets in active managed funds that are designed to outpace the marketplaces, but also 1/4 of the assets in areas where it makes sense in a low-cost fashion to index in a passive way to the various asset classes that they are into. So again, mostly active management, but 1/4 of the assets with index strategies. So going back to the one investment philosophy category of diversification by global risk factors, here we break it out in really four main categories: global equity, global fixed income, real assets, and diversifying strategies. And the idea here is to really impart upon committees the understanding that each has a specific role and a specific risk associated with it. Of course, global equity, as we would all guess, is the role of total return for the portfolio, and of course the risk associated with that would be the ups and downs of the market. Global equity, when we talk about that, is really looking at both public and private equities, as well as U.S., international, large, mid, and small companies. Global fixed income, similar in the sense that we're looking at both public and private, all bond sectors of the market, as well as U.S. and international. But their role within fixed income is to mitigate some of the risk that's going on with equities. You would have seen that example really with the fixed income last year during the pandemic, when essentially the equity market sold off in the first quarter of the year. It was really treasuries or fixed income and the like that were safe haven place for investors. And so that was a stabilizer for the portfolio during a time of fear in the marketplace. And of course, now that the risk environment is back online, we're seeing fixed income step back and global equities take over from a return standpoint. Real assets is also key in terms of inflation protection. We see that more so this year with concerns of inflation not being transitory, but more here to stay. And certainly the data points are showing month over month, year over year, increases in inflation, in some cases setting new highs. And that's got a lot of the market concern, certainly the Fed concern, as we will talk about that in a little bit. And then the last category of the four asset classes is diversifying strategies, what we would call active management that is not really correlated highly to global equities, global fixed income, or real assets. We utilize that in a manager called Evanston Capital Management for part of the portfolio. They manage a fund called the Weatherlow Fund, which is a fund of 24 underlying hedge funds and provides diversification and, again, active management that's uncorrelated to the first three categories here. The reason why we diversify amongst the different asset classes or strategies is really no one asset class is dominant year in and year out. It does have an ebb and flow to it. What you're seeing here is a periodic table of investment returns from 2003 on the left-hand side to 2020 on the right-hand side. And again, the top box would be the best performing asset class, bottom box would be the worst. And you can see the variability of returns from different asset classes. Namely, even last year, where small cap stocks were the best performer, up 20% last year, followed by large cap equities and emerging markets, which were each up about 18.5% in 2020. Emerging markets kind of caught a lot of people off guard with that kind of return because most people thought, well, emerging markets, it really hasn't done much. It's really U.S. equities doing all the heavy lifting. But if you look over periods of time, such as 2003, 2005, 7, 9, and even 17, you can see that emerging markets was the best performing asset class over those years as well. The other thing I would train your eye on is the orange box in the middle of this slide. This is a representation of a diversified portfolio, say an endowment or a foundation that's investing about 2/3 of its money in equities, a third or so into fixed income. And you can see last year's return would have been about an 8.2% return for a diversified portfolio like that. However, I would say that the Community Foundation did better than that. It was up 14.8% last year, probably within the top 3 or 4 asset classes from a performance standpoint, but with a portfolio instead of just one asset class achieving that return. The other thing is that we do instill that long-term perspective I talked about, because certainly March of last year was kind of a dark time with the pandemic. The market value of the portfolio was down to around 70 million in assets, but we stayed the course, rebalanced into equities, taking advantage of that opportunity. And then through September of this year, seeing the market value of that portfolio go from 70 million up to 101 million. So roughly about a 32 million increase in market value of assets over that short amount of time. So let's talk about the current market environment as it is today. What you see here is a graph that looks at the third quarter ending performance for various indices. And again, we're grouping them in the same kind of categories as we had before: global equities, global fixed income, real assets, and the diversifying strategies or hedge fund strategies. And what you're seeing is, like, for example, the S&P 500, their quarter, 1 year, and 5-year returns. So the quarter wasn't very impressive, and most times the third quarter, and specifically September of a year, not always a great quarter from an equity standpoint. And most of the indices were flat, maybe in some cases negative, like international markets or even emerging markets, which were down 8%. But if you take a look at the 1 and 5-year returns for those global equity indices, the S&P 500 was up 30 and 17% respectively for the 1 and 5 year. EFA, the International Large Cap Index, was up nearly 26.9% on a 1 and 5 year basis. And even emerging markets was up 18 and 9% over a 1 and 5 year basis. So very strong performance that we've seen a little longer term than the most recent quarter. In fixed income, as I mentioned, with rates, in the fixed income market, rates have been going up. That's been a headwind for returns. So fixed income, which was a safe haven last year, has been kind of a downer this year. As the 1 year returns only down 0.9%, but it's still down and not doing the risk mitigation that you would expect in a risk-on environment. But really, like I said before, bonds are just really the insulator of volatility against your equities when there's a time of fear in the marketplace. And that happened in 2020. Since we don't have that issue going forward, it's been your equities that have been doing really well. And taking a look at each of these components, global equities, for example, here you're looking at the quarterly performance of the various indices here. The top performer last quarter being frontier markets, which is a subset of emerging markets, followed by U.S. large cap equities, and then international developed. So again, the quarter was not very kind to a lot of the equities, as you can see on the quarter. Many of them were flat to slightly negative, or in the case of emerging markets, it was actually 8% down on the quarter. And again, that's largely due to China and the way the government has been getting more and more involved with private sector of the market, and specifically some other issues with regards to Evergrande, which is a real estate company that had a lot of debt issues that the government seems willing to let that company fail as an example. And obviously that's created ripple effects for some of the international markets. Not so much here in the US, because when you look at the year-to-date returns through September, US large caps up over 18%, small cap equities were up around 15%, and even international developed close to 8% on a year-to-date basis through September. Fixed income wise, rates going up. Again, that's going to be the headwind for most fixed income. What we've seen in terms of performance in fixed income is really areas that of concern with investors, namely inflation, have really got people investing in TIPS or Treasury inflation securities. So that standpoint, that's a sector of the market that was up 1.8% on the quarter and closer to 6.5% on the year-to-date basis. But also riskier sectors of the bond market have done really well. High yield and bank loans have done not only well in the quarter, up about 1% each, but also on the year-to-date basis through September, they're both up about 4.5% to 5%. On the real asset side, that's the one that's been really the eye catcher, obviously, is the price of the pump. We're seeing energy spot prices up significantly, natural gas prices up significantly, and it's no coincidence that the best performing asset class within real assets in the quarter was energy, up 21%. When you talk about West Texas oil, a barrel of oil price there is over $83 a barrel. And returning wise, it's up over 72%. Natural gas is up almost nearly 70% as well. And so again, those are some of the sectors that have done really well in the marketplace of real assets. Precious metals, which is kind of like what Treasuries was in 2020. Gold was a safe haven play in 2020, did real well. This year, you can see precious metals is down about 4.5%. And again, not as strong of a performance as it was last year, but clearly there's an ebb and flow in terms of real assets for a lot of the areas, REITs, energy, and certainly pipelines and other commodities that were down last year or up significantly this year. And of course, like I said before, gold, which was up last year, being down this year because we don't need that safe haven play, so to speak, for this year. On the currency front, despite the strong economic U.S. recovery, we're seeing dollars continue to rise relative to other currencies, up 1.9% here in the most recent quarter, and really at the expense of emerging markets, which again, has been down about 3.5%. A lot of that due to a lot of volatility overseas, specifically with China. So some of the other key macro developments that are going on before I touch on the foundation's results. What we see is certainly the Fed met in early November. They did not adjust interest rates at that time. However, the big dominant macro theme this quarter has been really laying the groundwork for tapering and the reduction of that. As such, right now the Fed's been buying about 120 billion in treasuries and agency mortgage backs. They've set a roadmap out to start reducing that by the end of this month, for starters, by 15 billion a month. So by the time we get into next summer, QE would be wrapped up. It also talks about, you can also kind of get a hint for what the Fed's looking at doing in the upper right-hand graph, where you see the market implied pace of Fed rate hikes. That's implying that over the next 2 years, we may see 3 rate hikes. Over the next 3 years, close to 5 rate hikes. And again, not to draw too much of a concern, because we're coming off a low point of 0, but those it could be quarter point increases each time. Even if it was 5 increases, quarter point each would be 1 1/4. Again, nothing to be too alarmed at, but certainly, the one thing that will be a factor is the second bullet point, which is the multi-decade high of inflation that we're seeing from a measure that the Fed looks at, the PCE inflation index, which is at the bottom right of this chart. You can see it's up 3.6%, a 30-year high, and that's got a lot of people's attention on that factor, whether or not inflation is really transitory or really something more elevated. The other things that are looked at from an inflation standpoint and surprises, there's an index called the Inflation Surprise Index. It typically looks at incoming inflation data and looks at the degree of positive inflationary surprises that have occurred. And ironically, right now it's at a 2-decade high as it relates to inflation surprises. Some of that tied to oil, which we talked about, being up over 72%, over 83 bucks a barrel now. Being some of the driver of that entire inflationary environment, because we see oil up at a 7-year high. But it's also got people thinking about stagflation, which is the bottom graph, where folks have looked at all these inflationary factors and also started to look at incoming economic data that has started to cool significantly. And so as that has cooled, that started up the rhetoric around stagflation and whether or not it's really here to stay or not. Our view is that it's not. It's a bottleneck that right now at this point, the supply chain flux. But as things kind of get back on track, things will reverse and move more in a positive fashion. Some of the other macro clouds that are in place today is on the employment front. The top right graph that you see on monthly change in non-farm payroll. Looking at things here, we're looking at 22.7 million jobs lost in the red bars there since the pandemic hit. And then if you just look at the green bars to the right of the most significant drop in payrolls, you're looking at about 17.7 million jobs hired. So we're still about 5 million jobs less than where we were pre-pandemic. And if you add that headwind along with the things that I talked about with China, some of the debt ceiling uncertainties, we did resolve, at least seems like we resolved the infrastructure bill package. We just need a signature there from Biden. But again, we're seeing a lot of unknowns at this point start to play out. Still moving in a positive direction, even though consumer sentiment's been kind of ticking lower. But GDP, for example, at the bottom left here, you can see the estimates for the third quarter of this year were going to be about 1.25% for GDP. It did come in at 2%, so a little better than expected. That probably helped October start to kind of get off on good footing from an equity standpoint, along with earnings. And there's expectations that further GDP quarters down the road will be better than that. So some of the key takeaways that I want to share with you, again, inflation is running at a multi-decade high, and the Fed has started to lay out the roadmap for scaling back its QE. And of course, after that, some point at the end of next year or even in 2023, start looking at rate increases, which would be good certainly for those investing in money markets and CDs and savers in general. But certainly it would be helpful to see some roadmap to kind of getting us back to normal on that front. The historically elevated inflation rates paired with some of the ongoing loss of positive economic surprises has been somewhat concerning. Again, might slip into stagflation. More than likely, it's just really a bottleneck, and that will resolve itself over time. But then, of course, there are other headwinds out there too, whether it's Europe's energy prices, China's regulatory crackdowns, and the like. So again, there's a lot of concerns on a macro level standpoint, but earnings are coming in very good, better than 82, almost 90% of the companies reporting to the S&P 500 for the third quarter beat estimates. So that's very encouraging. And the expectation is that the economy is starting to slowly but surely recover from its supply constraints and move in a positive fashion. So with that, just kind of switch gears and kind of touch on the foundation as a summary. And share that one of the drivers of how we allocate the investments for the foundation is really driven by what is your spending, what are your fees, and how do you want to cover inflation. So from this standpoint, we call it a primary objective 7.5%. Sometimes I refer to it as a hurdle rate, but in general, you're trying to build an asset allocation of stocks, bonds, cash, or managers as such in those categories to help serve the needs of getting that 7.5% return. And again, we use 2% inflation because that's been inflation for the last 10 years. But if you use inflation for the last year of 5.5% or last 3 years of 3%, we still look at that primary objective factoring inflation regardless if it's fluctuating or not. And then we line that with our capital market assumptions. Here you're looking at the four broad categories again: global equity, global fixed income, real assets, and diversifying strategies, looking at each of the asset classes from an expected return and also expected risk or standard deviation standpoint. And you'll take note that U.S. large cap equities, the expectation for return, for example, large cap equities is only about 5% at the top left here. Part of that's going to be just driven where valuations are as a starting point today. This is looking out the next 7 to 10 years on expectations of returns. And certainly returns more recently have been very robust. But with a price to earnings multiple starting point of over 20 times earnings, that's even higher than where we were pre-pandemic. You've got to have a lower bar set for large cap equity just because of that and where earnings are in general. And certainly year-over-year comparisons from 21 to 20, very favorable, very strong. But as we go into 2022, how do the year-over-year, quarter-over-quarter comparisons start to work? And so that's certainly why the reduced expectations. On the bond side of things, bonds, typically you're looking at the yield as the driver of return, unless you get fear of the market to drive rates down and up returns. But if you're looking at a 10-year treasury yielding 1.5% and not a lot of movement in interest rates, that's pretty much what to expect out of fixed income. And that's why you see the interest rate sensitive strategies at 1.4 or roughly 1.5 if you're looking at 10-year treasury. A little bit higher when you get into non-investment grade investments or private investments. But again, in general, those are some of the driving mechanisms for return. Another way to express this is more a dot plot of sorts, where the x-axis is expected standard deviation or risk, the y, the expected return. And if you just said if we were spending arbitrarily 4.5%, 5% and drew a line from the expected return from left to right, you would see that there's some asset classes that would fall underneath that bar of spending of 4.5%, 5%, and some that would be above it over the next 7 or 10 years. And so the idea would be to embrace more strategies that will help us get the spending and cover it than not, like within commodities and possibly core investment grade fixed income. So when we look at asset allocation each year with the committee, this is an example where we're taking those capital market assumptions, our expectation for return, that hurdle rate that we talked about, the foundation needs to spend 4.5%, cover fees of 1%, and then inflation. We're trying to drive an asset allocation that's closer to that hurdle rate. Here we're looking at the current target now, looking at the global equity percentage that we have, the global fixed income percentage we have, and the diversifying strategies, and then coming up through the Monte Carlo simulation of those capital market assumptions to come up with a return expectation of about 5.7%. Now, a lot of that asset allocation modeling is driven by the fact that you're using indexes as a proxy for the various asset classes. As I mentioned before, 75% of our managers are in active strategies that have had a really good track record of outpacing the indices. So typically, we're looking at 1 to 1.5% advantages over the target weighted benchmark or benchmarks that we're modeling here. And so you do add 1 to 1.5% to that 5.7%, you're right around our hurdle rate of covering the return needs of the foundation. And actually, and historically speaking, over the last 10 years, we've averaged a return of closer to 9.3%. net of fees. So, we've been well above the return expectation of 7.25, and certainly well above this expected return that's shown here. More detailed expression of the same asset allocation that was on the prior page. Here it just shows you the roughly about 14 different asset classes that you're utilizing here, and you look at current or target. Large cap equities, US, mid cap equities, US, small cap, international, large and small, emerging, private equity, private debt, we use both high yield and some other strategies within the mix. So again, overall, the mix is designed to kind of encapsulate the various returns of the marketplace, going back to that periodic table of returns. We're not sure which ones are going to lead, which ones are going to follow, but we do know that we need to have a certain allocation to help us make ends meet in terms of that hurdle rate, cover that spending, cover the inflation. So from a performance standpoint, here are the net of fee returns as of September of this year, and comparing that to a target weighted benchmark. The benchmark that's identified in the footnotes here, but is representative of how we're investing, with 40% in US equities, 20% in international equities, another 16% in investment grade fixed income, hedge fund strategies, as well as investment grade commercial mortgage-backed securities. So when you look at the performance here, you see year to date, 1 year, 3 year, 5 year, 7, 10, and since inception, all outpacing the index net of fee basis. If you were looking at our hurdle rate, we're covering that as well. As we kind of look at the hurdle rate of return of 7.5%, we're covering that over multiple periods, year to date, 1, 3, 5, 7, and 10. And again, outperforming that on a net of fee basis, and that allows the foundation to have real growth of assets, allow it to spend as much as it can in real dollar terms, not only today for the community foundation, but certainly going out 50 or 100 years from now. So with that, I'll turn it over to questions that you might have, and I'll stop sharing my screen here.
Well, not seeing any questions, I'd like to take this opportunity to thank you, Bill, and FEG for today's presentation, along with your continued work for supporting the foundation in our community. My name is Richard Brown, and it's my privilege to serve as the CFO for the Findlay-Hancock County Community Foundation. And as Bill just detailed through his report, we have really had our positive impact on the community enhanced through the strong market performance and the work that FEG does. So we're very thankful for that. If you do have any questions after today's presentation, feel free to contact me or Brian. We'll be happy to address those and work on them with you. A copy of today's both presentation and the materials, so the PDF slide deck, will be available in the coming days on our website. Seeing no other questions come in, thank you very much for attending the 2021 investment briefing, and have a wonderful day.